So my title is 2 years in, how much more to go? Nearly 2 years ago at a MIF podium, it was actually the one preceding PDAC, I predicted to the audience that the big turn in gold, we were right around $2,000 trying to break through. The big thing we needed to break through was 2,100 to prove that this time was different. And I told the audience that it was imminent. The timing was tough, nobody really knew, but it felt imminent to me. I did not know how imminent it was. It had started while I was speaking. Gold went up $40 that day in early March, and it did not stop. So right now we have to look back and say, after this amazing run, how much more do we have? Those of you that have gathered here to hear that from me are going to be sorely disappointed because I don't know, and nobody else does. This kind of a market, in fact, is a great differentiator among market pundits like me. If there's anybody who comes up here and tells you it's going to the moon, it's going to keep going, and we're not going to have some setbacks, and you should not take profits, that's not somebody you should be listening to, frankly. So what I'm going to tell you, what I'm going to give you, are not predictions. I'm going to give you some possibilities based on history, in some cases gut feeling, and perhaps some probabilities. And it's up to you to take it from there. But remember, I'm in it with you. I'm trying to figure this out just like you are. So let's get in, let's get started. A hell of a run so far. And Rick was talking about a hockey stick. The last part of that graph really does resemble one, doesn't it? We have not seen anything like this before. You know, history doesn't repeat. It sometimes rhymes. This is a hell of a rhyme. For a number of reasons, some of which I'll go through in this presentation. This is historic, this is unique. In the long history of gold as an investable asset, going way back to August 15th, 1971, we have never seen anything like this before for a number of reasons, not just in the violence of the moves, but what's driving those moves. Record after record after record. This, of course, is a few days old. Gold has reached 95 new all-time highs since 2024. It's adding to that number every day. This chart is already out of date. This is why I had to update my presentation after the market closed yesterday, because every chart would have been dramatically out of date if I hadn't done that. It's a different bull than any other. We've had big runs, but no deep corrections. The corrections that we have had in this market have not been the kind of corrections that standard, typical technical analysis would have predicted. In every drop that we've had, you've seen the technicians in the market, the technical analysts predict that we're going much lower. We're dropping 20, 30% in this correction, but we have not. We've had 10% drawdowns. Both of them largely due to the involvement of Western speculators, but they have been largely absent from this market. The big driver in this market has been the central banks, and that central bank buying has not only driven the bus, but it's kept it on track. When we've had these corrections, they've instead of very deep corrections, we've had sideways trading action for some period. And we just got through another one of those late last year. We're accelerating again. We're likely to have at least another one of those sideways corrections. Time will tell if this time the central banks will support that to no more than a 10% correction, or whether the involvement of more speculative interests will give us a more typical correction like we've been used to in past bull markets. Again, central banks are driving the bus. This chart shows in the blue line, the gold share of international reserves. The red line is US dollar share. Some charts you have seen, mostly propagated by my friend Tavi Costa, show that at least denominated in US treasuries, gold has already surpassed the US dollar. And it's not like gold is just rising. They are buying gold. They are switching to gold in favor of gold and to the detriment of the dollar. This is, in some ways, a de-dollaration trend. In some ways, it is a sell America trend. In some ways, it's a recognition of the fact that gold is the real stable asset out there. And some things I'm going to get into right now shows that the dollar and other fiat currencies, not just the dollar, are not the stable long-term stores of assets, stores of value that they would hope to be. So what we've seen, and what we've seen since late summer, is that Western investors and some others have joined the party. It all started, or at least this latest run started, on that day in August 22nd, when Fed Chairman Jerome Powell stepped in front of the podium in Jackson Hole, Wyoming, and basically conceded in Fed talk a quarter-point rate cut. The market then immediately projected another couple of rate cuts, at least from this Fed. Then we got some negative jobs data, and then they started projecting a few more rate cuts from this Fed. Then they looked to next May, when Trump will have his person in the Fed chairman's seat, and we all know what that person is going to do in regard to rate cuts. So the market at this point, at that starting gun, began to factor in a new multi-year rate cutting cycle. A rate cutting cycle, by the way, that was absolutely mathematically necessary. Now, coincident with this, mining stocks started to outperform gold. And really, it started right about August 1st, like it was shot out of a gun, that all of a sudden GDX, or the mining stock indices, started to outperform gold. That is no small feat. When you consider what gold has done for the mining stocks to finally leverage the metal, and these are the big producers, that is no small feat. That's quite an accomplishment. That shows that some investors, that Western investors, are finally getting involved in the market. And seeing how far gold had risen, they were coming into the market in two sectors that are typically leveraged to it: the mining stocks and silver. What's interesting about this is that GDX during this period actually had significant outflows. The fund itself had outflows, but the components of that fund were rising rapidly. That showed not only that Western investors and speculators were getting into the market, but they were being selective. They were actually going into the individual names. Gold ETF buying, that surged during this period, but in fact, this proxy for physical gold, the paper proxy for physical gold, had been rising all year. Silver soars. What can you say? After it cleared $35, we all said it's going straight to 50, and it did. And we said after 50, it's got clear sailing to 100, and it has. In full disclosure, I sold some silver stocks yesterday. And that kind of, it rhymes with what Rick was saying. You have to take money off the table in some instances. And when a bell rings that loudly, that's a good time to take at least some of that money off the table. Stable coins are another big buyer in the market. Tether Gold is one of the biggest buyers out there, equal to a number of central banks. We have, fortunately, two simultaneous secular bull markets going on at the same time: monetary metals and base energy metals. The reasons: monetary debasement for the monetary metals, gold and silver; supply constraints coming up against soaring demand for the base metals and really every other commodity. We are in a commodity supercycle. Why are we seeing this? Well, some things never change. That chart in the back is the purchasing power of the US dollar. The one in front of it is the purchasing power of the Roman silver denarius. If you want to talk about rhyming, that's rhyming. This is an age-old story. It's happened throughout human history. Leaders, governments, civilizations will overspend. They will debase the currency. That is precisely what's going on right now. Here's a chart that one of the great analysts out there, Alistair McLeod, has recently put out: gold in Reichsmarks during the great inflation of the 20s in Germany, and gold in US dollars. Now, the sharp-eyed among you will notice that the upper chart is log scale, so it's not exactly as dire as this may seem, but the shape of the curve is similar. So what causes declines in a currency's purchasing power? Spending and debt creation. U.S. national debt, $38 trillion, 0.637. It's a lot more. This is a few days old. So there are billions and billions of dollars added to that. The important numbers on here at the bottom circled in blue. 1980, the federal debt was 34.5% of GDP. So Paul Volcker had a toolbox. He could raise rates to kill off inflation. Now at 124%, and in some cases rising, Powell and the next Fed head have no tools left in the toolbox. They cannot raise rates, and here's why. This is the service costs on the federal debt. This is what has happened just as the Fed started to raise rates in this last rate hiking cycle. You can see what happens when the debt is so large. Even small increases in interest rates have a outsized bottom line impact. The leverage is tremendous. We cannot afford to do this. This is more than national defense spending in the US. Bottom line is we've entered the end game of a 4-decade-plus process of ever easier money. That's the big picture going on that's driving a lot of the money going into gold around the world, not necessarily in the US. We've talked about this, you know, I've talked about this for 10, 12 years and spent thousands of words and copy and speeches talking about it, and I didn't have the idea to just call it the debasement trade. That's the marketing that we've seen from Wall Street. That's what is making this a thematic trade on Wall Street. That's bringing big money into the sector. Jerome Powell, this is the bottom line, has already launched a return to easier money. His successor will accelerate it, and that brings us to where we are today. That is why this trend will have a fundamental underpinning going forward. It's important for us to look at where we are here. This is Agnico Eagle, widely regarded as the finest of the big producers. You see that stock chart. Are mining stocks still at these levels undervalued? Well, here's the Agnico Eagle average price to earnings ratio over time. Trailing 12 months is lower than it is today, but 3-year, 5-year, 10-year, 15-year, 20 years, its PDE is still at its lowest end of the range, despite that run. The profits these companies are making, their average profit margin of a miner today, their profit margin for every ounce is far larger than where the gold price was last year. This is tremendous. They are making money hand over fist. What we're seeing now, this comes from our friends at In Gold We Trust report. The blue line at top is the large gold miners divided, well actually the one at the bottom is the gold line is gold over the large cap gold miners. When that line is going up, the GDX GLD is the lower line. When it's rising, the mining stocks are outperforming gold. The top line is the junior mining stocks divided by the, actually the big majors divided by the juniors. When that top line is dropping, then the juniors are outperforming the majors. That is precisely what we need to see for all of those companies out there to benefit. This market is evolving. It's unique, but it is evolving, albeit belatedly, like previous bull markets. Who's buying? I'm not sure. There is more buying out there than we are aware of. China, for sure, is buying a whole lot more than it's reporting. But my sense is the violence of these moves, there's some other big buyer out there. I think it's curious that the administration, U.S. administration, mentions of an audit of Fort Knox. According to Twitter X, they peaked in February of last year, and then they went radio silent, talking about an audit of Fort Knox. Coincidentally, the gold price took off. So I think it's very likely, very possible that one of the big buyers out there is the U.S. government itself, putting gold where it should have been all along. In short, this is another long-term monetarily based gold bull market like the 70s and 2000s. Let's take a brief look, I'm way over time, of how high we can go. You have 4 bull markets shown here. The first, the early 70s, then the late 70s, then the 2000s. In those 3 historic bull markets, gold price from trough to peak went up 5.6, 8.2, 7.5 times. If you mark the bottom of this cycle at $1,050, that says we're likely going to get to $6,000 to $8,000 at the end of this cycle. A couple of months ago, I would have told you that might take a few years, 3 to 5 years or so. It might be 3 to 5 months, who knows? But things are really accelerating to the upside. Alternative reading of this, if you count the 70s as one long bull market, then the gold price went up 24 times. That would imply a gold price in the mid-20,000s. That in turn would imply some sort of a monetary reset. I don't think that's likely on this run, but I want you to know that that's an outlying possibility. And I'll close with this chart, which is a fascinating chart from Nick Laird, who does the goldchartsorus.com site. Great site. This is gold days to double. And he divides the 70s and then marks another low in the 2000s. If you look at this chart, you can see that in the 70s there were 5 doublings, and toward the end, we actually had 2 blow-off tops during that period, during the 70s, where it took gold only a matter of, a little over a year to double in price. If you look going back from the 2000s, you can see that we just completed the 4th doubling of the gold price. And that was when gold got to about $4,000. That 5th doubling, if that's all we get, means we'll get to $8,000. Again, that jives with what I just said about previous bull markets. One of the things I also want to point out, kind of an alternative reading on this, is those 2 blow-off tops in the 70s. We could have a blow-off top now. We could have a 2-year respite correction like we had in the 70s, of some period at least, and then take off again toward those higher levels. I think the 70s, to a large part, was divided in, okay, we've severed our tie to gold. Something bad's going to happen. We don't know what, but it's going to happen, and gold soared. And then the latter half of the 70s is when that bad stuff actually happened. So what we might be seeing right now is the whole world worried about what will happen, and then we may take a break, and what we were fearing, what we were worried about, actually does happen. So that's all from me. GoldNewsletter.com, the world's best investment conference, resource investment conference, New Orleans Investment Conference. This fall ends on Halloween. You got to check that box off if you've never been to Halloween in New Orleans, and follow me on X.